In the vibrant landscape of the late 2010s, a company emerged with a vision to revolutionize the way we work and live. WeWork, co-founded by Adam Neumann and Miguel McKelvey, promised more than just office space. It offered community, culture, and a sense of belonging. At its peak, this audacious dream was valued at an astounding $47 billion, transforming co-working into a global phenomenon. It was a beacon of modern enterprise, seemingly unstoppable, an emblem of Silicon Valley's boundless ambition and investor fervor. The world watched as WeWork expanded with breathtaking speed, challenging traditional paradigms. At the heart of WeWork's meteoric ascent was Adam Neumann, a figure as enigmatic as he was charismatic. Born in Israel, Neumann possessed an undeniable ability to articulate a grand vision, drawing investors and employees into his orbit with an almost messianic zeal. He wasn't just selling desks, he was selling a lifestyle, a philosophy. His unconventional leadership style and boundless energy became synonymous with the company's identity, inspiring both fierce loyalty and, eventually, significant skepticism. Neumann's personal brand was inextricably linked to WeWork's public perception, driving its narrative. Founded in 2010, WeWork began with a single location in Soho, New York. Its core offering was simple yet compelling: flexible office spaces, replete with stylish design, amenities like free coffee and beer, and a vibrant community manager. This model resonated deeply with startups, freelancers, and even large corporations seeking adaptable and engaging work environments. The company rapidly expanded its footprint, securing long-term leases and transforming them into short-term memberships. WeWork wasn't just renting out desks, it was crafting an experience, a movement that promised to redefine the urban professional landscape across the globe. The true catalyst for WeWork's hypergrowth arrived in the form of SoftBank and its visionary, Masayoshi Son. Son, known for his audacious bets on technology companies, saw in WeWork not just a real estate play, but a revolutionary tech platform. SoftBank poured billions into the company, fueling an aggressive global expansion strategy that saw WeWork open hundreds of new locations at an astonishing pace. This influx of capital allowed Neumann to dream even bigger, transforming WeWork from a co-working space provider into a sprawling ecosystem. This massive investment was both a blessing and a curse, accelerating growth while obscuring underlying financial realities. With SoftBank's backing, WeWork's valuation soared to unprecedented heights. From modest beginnings, it quickly reached unicorn status, then megacorn, eventually peaking at an incredible $47 billion in early 2019. This made it one of the most valuable private companies in the world, eclipsing established players and raising eyebrows across financial markets. The sheer scale of this valuation, for a company primarily engaged in subleasing real estate, suggested an almost fantastical belief in its potential. It embodied the era's growth at all costs mentality, where market share and user acquisition trumped traditional profitability metrics. Emboldened by its valuation and investor confidence, WeWork began to diversify, venturing far beyond its core office-sharing model. This expansion included WeLive, an attempt to create co-living spaces, WeGrow, an experimental private school for children, and Rise by We, a luxury gym and wellness offering. These ventures, while seemingly aligned with Neumann's community vision, stretched the company's resources and blurred its identity. Critics questioned the strategic coherence and operational viability of these disparate projects, hinting at a lack of focus that accompanied the company's breakneck growth. The We ecosystem was becoming increasingly complex and expensive to manage. As WeWork prepared for its initial public offering, IPO, scrutiny intensified, revealing deep concerns about its corporate governance. Adam Neumann's control was expansive, holding a majority of voting power through supervoting shares. Numerous instances of self-dealing emerged, including his leasing properties he owned back to WeWork and trademarking the We brand, then selling rights to the company for nearly $6 million. These actions, combined with a seemingly cavalier attitude towards financial discipline, painted a troubling picture for prospective public investors, suggesting a founder whose personal interests were intertwined with the company's in problematic ways. Neumann's personal life mirrored the company's high-flying ambitions, often blurring the lines between corporate and private expenditures. Reports of lavish parties, a multi-million-dollar private jet, and an overall culture of extravagance became public knowledge. These perceived excesses, particularly for a company still bleeding cash, clashed sharply with the image of a fiscally responsible leader. The perception grew that while WeWork was burning through investor money at an alarming rate, its founder was enjoying a lifestyle more befitting a seasoned billionaire than the head of a rapidly expanding, yet unprofitable, startup. This spectacle of opulence further fueled investor apprehension. Despite its surging revenue and global presence, WeWork consistently reported staggering losses. The company's business model, which involved signing long-term leases and then re-renting spaces on a short-term basis, exposed it to significant financial risk. The S-1 filing ahead of its IPO revealed a company burning through billions of dollars annually, with no clear path to profitability. Analysts questioned how a company with such high fixed costs could ever justify its tech company valuation. This fundamental mismatch between a real estate operation and a tech valuation became a central point of contention, undermining confidence in its long-term viability. The moment of truth arrived with the public release of WeWork's S-1 prospectus in August 2019, the mandatory filing for an IPO. This document, intended to entice investors, instead exposed a trove of alarming details that sent shockwaves through financial markets. Beyond the substantial losses, the S-1 revealed complex financial structures, questionable related party transactions, and an unusual emphasis on a community-adjusted EBITDA metric that excluded numerous significant expenses. It laid bare the company's dependence on continuous capital injections and the precariousness of its financial foundation, raising serious questions about its true operational health and sustainability. The S-1 filing triggered an immediate and ferocious backlash from investors and financial analysts. What was meant to be a showcase of future potential became a stark revelation of current flaws. Public market investors, unlike the private venture capitalists who had funded WeWork for years, demanded clarity, profitability, and sound governance. The lack of a clear path to generating profit, coupled with Neumann's absolute control and perceived conflicts of interest, made the company an unpalatable prospect. The narrative quickly shifted from a revolutionary tech disruptor to a precarious real estate play, struggling to justify its inflated valuation. Skepticism turned into outright alarm. The media, initially enamored with WeWork's rise, quickly turned critical. Articles dissecting Neumann's management style, the company's finances, and its perceived corporate extravagance became front-page news. Social media buzzed with memes and discussions, turning the WeWork story into a cautionary tale about venture capital excess and the perils of unchecked founder power. The public image, once polished and aspirational, began to crack under the weight of intense scrutiny. This collective scrutiny created immense pressure on the company's leadership and its board, making a successful IPO increasingly improbable. The We community felt less like an inclusive vision and more like a carefully constructed illusion. As the IPO prospects dimmed, the pressure on Adam Neumann became unbearable. Major investors, particularly SoftBank, grew increasingly concerned about the damage to the company's brand and its ability to secure public funding. The board, once seemingly under Neumann's spell, began to assert itself. Calls for his removal from the CEO position grew louder and more insistent. It was a swift and dramatic reversal of fortune for a founder who had once commanded absolute authority. The very characteristics that had driven WeWork's rapid growth, Neumann's charisma and singular vision, were now seen as liabilities, threatening the company's very survival. In September 2019, amidst the escalating crisis, Adam Neumann officially stepped down as CEO of WeWork. His departure, however, was not without controversy. Despite leading the company to the brink of collapse, he walked away with a significant severance package and a massive stock grant. This golden parachute sparked outrage, particularly among employees and smaller investors who faced an uncertain future. His exit marked a pivotal turning point, signaling the end of an era defined by audacious vision and unbridled ambition. It was a messy, public divorce between a founder and the company he had built, leaving many questions unanswered about accountability. Following Neumann's departure and the abandoned IPO, WeWork's valuation plummeted spectacularly. The company that was once worth $47 billion saw its private market valuation collapse to less than $10 billion, a staggering drop that wiped out tens of billions of dollars in perceived value. This dramatic revaluation reflected not only the loss of investor confidence but also a stark recalibration of what the company was truly worth. It was no longer a tech giant, it was a real estate company facing a challenging market, burdened by long-term leases and significant operational costs. The illusion had been shattered, revealing a much harsher reality. With WeWork teetering on the brink of bankruptcy, SoftBank, already its largest investor, stepped in with a lifeline. The Japanese conglomerate launched a complex rescue package, effectively taking majority control of the company. This involved a new $5 billion debt package and accelerating an existing $1.5 billion investment. Masayoshi Son, who had once championed Newman, found himself overseeing the painful restructuring of his once prized investment. It was a costly endeavor for SoftBank, forced to pour more money into a troubled asset to prevent its complete collapse, highlighting the immense risks of unchecked venture capital spending and the pursuit of aggressive growth. The period following the failed IPO and SoftBank's takeover was marked by painful restructuring. Thousands of employees were laid off globally as the company sought to cut costs and rationalize its operations. Non-core ventures like WeLive and WeGrow were either shuttered or divested. The focus shifted dramatically from hypergrowth to fiscal discipline and a clear path to profitability. New leadership was brought in, tasked with the unenviable job of stabilizing the fractured empire and restoring investor confidence. WeWork was forced to shed its image as a tech disruptor and embrace its identity as a more conventional, albeit modern, real estate company. This was a brutal but necessary transformation. Under new management, WeWork embarked on a rigorous journey to redefine itself. The emphasis moved away from the We ecosystem and back to its core business of providing flexible office solutions. A more traditional approach to corporate governance was implemented, aiming to reassure wary investors. The company worked to renegotiate expensive leases and streamline its operations, focusing on efficient space utilization and customer satisfaction rather than sheer expansion. While the grand, almost utopian vision of Adam Neumann had faded, a more grounded, sustainable business model began to take shape. It was a slow, arduous process of rebuilding trust and fundamental value. The WeWork saga serves as a profound cautionary tale for the startup world and investors alike. It highlights the dangers of prioritizing rapid growth over profitability, the intoxicating power of charisma without accountability, and the perils of inflated valuations unbacked by solid fundamentals. The company's near collapse underscored the critical importance of robust corporate governance, transparent financial reporting, and a clear, viable business model. For venture capitalists, it emphasized the need for more rigorous due diligence and a less permissive attitude towards founder control. WeWork's journey became a harsh lesson in the difference between aspiration and sustainable reality. Today, WeWork continues its efforts to navigate a post-pandemic world and redefine its place in the flexible office market. It eventually went public through a SPAC merger in 2021, at a significantly reduced valuation compared to its 2019 peak. While still a major player, it operates with a much more conservative approach, focusing on its core strengths and adapting to evolving work patterns. The story of WeWork remains a complex narrative of ambition, innovation, and ultimately, a painful reckoning. It's a testament to the fact that even the most compelling visions must eventually confront the immutable laws of economics and sound business practices. The future is uncertain, but the lessons are clear.